Have you ever looked at your mortgage balance and wondered, how am I making good money, paying my mortgage every single month, and yet my loan balance barely seems to be moving? If that's you, you're not alone. In fact, this is one of the biggest frustrations I hear from homeowners they're financially responsible, they have steady income, and they're doing everything they think they're supposed to be doing. Here's why. Most traditional mortgages are heavily front-loaded with interest. That means during the early years of your loan, a large portion of your monthly payment goes towards interest, not principal. In fact, during the first 8 to 9 years, 80 to 90% of your payment goes towards interest. Let's say that you have a mortgage payment of $3,000 per month, and you're assuming that after making payments for several years, you've knocked off a significant amount off your loan balance. But when you actually look at the numbers, you're going to discover that only a small portion of these payments has reduced what you actually owe. That's because of something called amortization. And while amortization, it's been around for a long time and it has been a very good thing, it can feel frustrating when you're trying to build equity faster. Now, let me talk about something different before we go to the next step here. It's something that I see all of the time. Many homeowners, they keep a substantial amount of money sitting in a checking account or a savings account. It may be an emergency fund. It may be money that's just waiting to be invested. Or it might be simply excess cash that you got from a big bonus you earned that month. The problem? That money is usually doing very little for you. It's sitting in an account earning a relatively small return while your mortgage balance, well, it continues to accrue interest every single day. So even if you're financially successful and earning good income, your cash and your mortgage, they're operating in two separate worlds. One is sitting idle. The other is costing you interest every single day. This is why many homeowners, they feel stuck. They're making the money, they're making their mortgage payments, they're saving cash, and yet they're not seeing the progress that they expected. So that's where some of these alternative mortgage strategies like the all-in-one loan often get people's attention. Instead of keeping your income, savings, and mortgage completely separate, the all-in-one loan is designed to allow your available cash to work towards your mortgage balance. As money comes in and out, your average balance will be reduced, and that will help you reduce the amount of interest that's charged over time. The result? Well, many homeowners, they gain more control over how they manage cash flow and potentially accelerate the mortgage payoff compared to that traditional mortgage structure that you're used to seeing. Now, this strategy isn't right for everyone, but if you're wondering why your mortgage balance seems to be stubbornly slow to decrease despite having your strong income, healthy cash flow, this loan, it might be worth exploring, because sometimes the issue isn't how much money you're making, it's how your money is being positioned to work for you. If you'd like to learn more about how the all-in-one loan works and whether it could be a good fit for your financial goals, reach out and let's talk and let's have a conversation.